All right, welcome back, traders. John Caruso here. Another edition of Futures Forecast for the week of November 28th. I am recording this on Sunday evening, the 27th. We're going to do a quick recap of some of the trading action that we saw last week. And then, of course, we're going to take a peek into our crystal ball here, and we're going to take a look at the charts and see what is to come potentially for this upcoming week. So taking a look back at last week, we did see the holiday tradition of markets trading higher into Thanksgiving actually ensue. We did see the S&P 500 up 1.5%. The NASDAQ was up 0.72%, and the Russell 2000 finished up a little bit over 1% for the week. Gold prices gained 0.23%. Silver was the big winner in the metals market, up 2.3%, and copper lost 0.44% week over week. The big news actually may have came in the energy space, where we did see crude oil trade down 4.5%, gasoline down 6.15% for the week, taking that loss to minus 21% month to date. And the heating oil contract lost 9.5% as well. So clearly some problems in the energy space. Clearly, the market is more focused on demand destruction rather than the longer term supply side fundamental issues that are overwhelmingly bullish. But clearly, the market is focused on the possibility of a worldwide recession, as well as further lockdowns over in China late last week. We're going to talk more about that here in a little bit. We did see manufacturing PMIs come in weak, 47.6%. That is sub 50, which shows contraction. That shouldn't surprise anybody. It certainly doesn't surprise us. Durable goods, 0.5%. That is up month over month from a previous reading of minus 0.9%. And initial claims did rise to 240,000 versus last week's reading of 223,000. So let's take it to the charts here. First chart we're going to look at is going to be the December S&P 500. Clearly, we're staring at a bearish trend here on the chart, but we do have this near-term positive structure developing right now. We're going to call this bearish trend, but bullish trade. We measure trade on a 1 month basis, and of course, trend on a 3 to 6 month trending basis. And taking a look at this near-term action, clearly we do have a gap down here off the open Sunday night. Market has overhead resistance clearly at the 200-day moving average that converges with this downtrend line. This chart is still very much positively configured over the near term, so I still think we are in a rising phase, and that the market is likely going to attempt to attack this downtrend line, potentially push through it as high as 71.6 on the upside. The 71.6% Fibonacci retracement measures from this peak up here to this trough that we saw in mid-October. So the 71.6, that level comes in up around 41.50. It would not shock me to see the market try to play for that level before perhaps entering another period of risk out into mid-December and out into the turn of next year. So clearly a positive structure here. I still think a little bit more upside before we get a clear rejection on the charts, and we've got much more downside to come. I still remain very negative on this market. I'm just going to clearly call this what I think it is, and that is a bear market rally inside of a larger bearish trend. And we're going to use any rallies we're going to say around 4,100 to 4,150 as a place to reset some sell side strategies in the market. So keep that in mind. That's how we're looking at playing the December S&P 500. Flipping over here, we're going to take a look at the 10-year Treasury Index. All right, there's 10-year Treasury Index, which mirrors the 10-year yields. Clearly, we've got this longer-term positive structure here on the chart, but we are starting to see some signs of a breakdown right now in yields. And I actually do think the way yields are set up right now, clearly we're still bullish trend, but we are in a developing bearish trade right now. Momentum went negative over here on 11:15. I can see down here in my oscillator, we're still nowhere near oversold in this declining phase that we're currently in. So I still think 10-year yields are likely going to work their way down to this key support line down at 355. That's trend in our model. So if we were to break 355, we're going to be positioning bearish trend in 10-year yields. And that's likely going to be a little more friendly for the upside of Treasury bonds and bond investors going forward. So we're going to say that we play for 355 here over the near term, maybe get a bounce going into the December Fed meeting before perhaps this market has something bigger to say on the downside going out into the end of the year and the beginning part of next year. I'm going to show you something else that's kind of interesting with bond yields. It is a correlation chart of 10-year Treasury yields to crude oil prices. So this purple line graph that we have on here is crude oil. Clearly, you can see crude oil when it was in its rising phase in the spring, in the beginning part of the summer. 10-year yields were clearly following this market higher. They followed oil prices lower when oil prices started to come in, and then we saw this divergence on the chart where 10-year yields continued to climb all the way to that 433, while the crude oil markets continued to trade bearishly back on the downside. So now we're actually starting to see this period here where yields are now starting to correlate a little bit better with the 10-year, or I'm sorry, with the crude oil market. You see crude oil in this falling phase, 10-year yields back falling as well. So I still think that there is, quite a bit of room for 10-year yields to come down, just measuring it based on how closely that relationship with crude oil prices has been over the years. And I can actually take this all the way back. Let's take it to a weekly chart. You can clearly see that correlation on a weekly. Rising oil begets rising yields, begets higher inflation, et cetera, et cetera. So you can kind of draw your own conclusions from that regard. So that was a quick look at the 10-year yields correlated with oil. So still think 10-year yields still have some room to come down from this point. Taking a look at crude oil. Another rough night here for crude oil. Crude oil down 2.5% here off the open. You can take a look back last week. We still have it drawn on the chart where we actually thought, based on this bear market rejection that we got following those rumors that the Saudis were going to be pumping more oil, which then were refuted by the Saudis. And we did see the market actually trade higher for a day. We actually thought that it would sneak back into this, 84.50 to 86 level that was going to present a more attractive selling opportunity for crude oil. But clearly, crude oil had other plans, and we did see crude oil prices follow through on the downside last week. Like I mentioned, down 6.5%, down 4.5% for the week. And we're seeing more follow through on the downside in oil. And I still do not have oil in an oversold state. So this could still have some room to run on the downside over the next couple of weeks in crude oil. Let's take a look at a monthly chart. And we actually did highlight this as a possibility. Actually, let's take a look at a weekly. We can see it better on the weekly. The next level of support. We did highlight this last week, thinking that, okay, if we were to break down below this 76 area convincingly, and right now we are convincingly taking that level out, we're at 74.30 right now, that the next area that this market might try to play for would be this $65 area that we haven't seen since the end of last year. So $65 crude oil is very much in the cards based on this chart structure that I'm staring at right now. Clearly, the market is more focused on demand destruction rather than the longer-term supply-side fundamentals that are very bullish. We did get news late last week that Chinese COVID cases did rise to an all-time high, which threw the CCP back into lockdown mode. And then, of course, over this weekend, we did learn of news of civil unrest over there after the news of the Chinese apartment building that caught on fire. 10 people were killed because they could not get out of the building due to the CCP lockdowns. So pretty wild stuff that's going on over there. Something that you really have to pay attention to, because any signs that the Chinese are going to lift those lockdown restrictions could mark a long-term bottom, we think, potentially for crude oil prices. But right now, crude oil prices clearly focused on Chinese lockdowns, clearly focused on demand destruction with the potential rising probability of an oncoming worldwide recession. And that's the case right now for crude oil. And the bears clearly have control of that market. All right, we're going to flip over. We're going to take a look at the February gold contract. We just had the rollover. Let me see if I can spread this out a little bit here. take a better look at it. All right, so clearly we had the downtrend for the better part of the year. Then something changed in here with the better than expected consumer CPI readings. Market bursted out of this downtrend that it was in. Clearly overtook this downtrend line and really hadn't looked back. It rallied all the way up to 1790. Then we had a period of consolidation. The market did get oversold down in here, and we actually had some long side strategies that we put on. I want to say it was Tuesday or Wednesday of last week. Caught that reversal bar, a little more upside, took some profits. We still have some long side strategies that are still sitting out there. We still have gold prices still positively configured in this rising phase. And what I'm going to see if we can do here over the near term, we'll say the near term over the next 1 to 2.5 weeks, is if we can potentially make a run up to this 1825 area. We might struggle in this 1770 to 1790 area. But if we can punch through there, I think that unlocks another $30 in upside. That takes us up to that 1825 area in gold, where I think gold prices would likely fail once again out into we're going to say mid-December, and potentially make a play back towards 1730, this key low that was marked down here, or potentially as low back to this 1689 area. And I'm going to take a look at the weekly chart. And why do I think that this path is a probable path for gold prices? Well, if we can get up here to this 1825, 1830 level, that is going to set the neckline for the potential of an inverted head and shoulders bottom that would likely mark a longer term bottom for the gold market. We can see down here we had this rare triple bottom on the chart, and that is something that could be telling a longer term story, or foreshadowing a longer term story for gold prices to get an aggressive move up on the back on the upside some point out into 2023. So we're going to be paying attention to this very closely. That's why we think the probability that we can get up here at 1825 is rising to build that neckline, build that inverted head and shoulders for potentially some bigger price action to come out into 2023 and 2024 in the gold market. So I remain bullish of gold. Clearly, you can see here on the weekly chart that we did get a momentum change from negative to positive. I do have gold listed as bullish trend and trade right now inside the model. So we're going to see if we can accomplish this 1825 level in the gold market over the course of the next 1 to 3 weeks in gold before a period of risk enters back into the market going into that Fed meeting in mid-December. So that Fed meeting is going to potentially be present a lot of risk for the market, both in the stock market, both in the commodity markets, and potentially even in the treasury markets, to the point where I still think you're going to hear a hawkish Jay Powell. Yes, they're going to likely slow the pace of interest rate hikes from here, but I still think Powell seeing a 7 handle on inflation is still way out of bounds right now, and he has to stay hawkish in his dialogue and vigilant towards fighting inflation. So that's why I think going out to mid-December, a lot of my charts have mid-December pegged as a period of risk. And I'll even flip over to the US dollar one more time. Well, not one more time, but we're going to take a look at the US dollar, kind of a bonus chart here. Clearly, the US dollar has suffered a big hit over the last couple of weeks, did break that longer term trend line on the upside. And now we've entered this period of consolidation that we might be in. Perhaps dollars can move a little bit lower here over the near term, but I think anything down along 105.5 to 105 is going to be a buying opportunity for the US dollar going out into that December Fed meeting, which could take us back up towards that 110 level before maybe some more consolidation, and perhaps the US dollar has something bigger to say on the downside out into 23. But I think over the near term, the dollar is going to enter a bottoming phase for another reattack higher to potentially this 110 area. Let's draw in this trend line across those peaks, and that's where it kind of comes in back up around that 110.46 area is where I think the U.S. dollar could potentially make another play for in coming weeks. So keep that in mind. Hope all of that was helpful for you guys. Feel free to drop me a line. Go ahead and send me a note if there's any other charts that you want us to take a look at for you. Best of luck to everybody out there. We're going to catch you back here next week. Take care.